Hey, what's up, everybody? Tuesday. What is it? October 30th, one day before Halloween. Ooh, yeah. All right, all you dollar bulls, what are you doing today? What are you doing today? You're cheering, right? You're celebrating. You're popping the champagne corks. You're going crazy. You're giving high fives, right? Because the dollar index took out the August highs by what? 2 ticks, 3 ticks? I think 97.01, 97.02. The August high was 96.98. It took 2 months to claw back to the heights of 97, and you're all celebrating a tremendous victory. All right, let's just calm down, everybody. Calm down, okay? Calm down. If you've been trading as long as I have, hopefully you have some perspective. I know a lot of people here, you don't have perspective because I just read the comments. I have people posting, Mike, the dollar's going up. The dollar's going up. It's not going up. I mean, it's been around the same level now, going back all the way to June. But let's depart from that for a second. And let's talk about perspective, because that is very, very important. When you are involved in a macro trade, as I am, based on big policy implementation, policy that has been in effect, which has a medium to long-term impact on the markets. We're talking about monetary policy now with the Fed raising rates. And again, I'll just repeat quickly something that I've mentioned many times in the past. 8 rate hikes, okay? When the Fed started the rate hikes, the dollar index was at above, was almost 99. It was 98 and change. Today it's at 97. That's 8 rate hikes. And as a matter of fact, it did rally up to 104. It went down to 88. We're at 97. 8, not just 8 rate hikes, but a very hawkish position by the Fed right now. I mean, they're talking about a continuation of rate hikes. So 8 rate hikes and a hawkish stance where no other central bank in the world right now, you know, some of them are raising interest rates. A little bit, Canada did it last week, all right? But really nobody's doing it. So the Fed is alone in this, very hawkish, 8 rate hikes, and the dollar index is down. So let's just establish that one more time and set it aside. Now, I want to talk about a macro trade. What is that? Based on a major policy shift that went into effect on December 2015, which I pointed out at the time, which I've been talking about. In addition to that, an historic fiscal expansion that is going on right now in terms of the amount of spending, U.S. government spending, the deterioration in the U.S. trade balance, those things, big macro factors that affect exchange rates, okay? When you are looking at a macro trade of this importance, of this duration, I should say, you're talking about trends that evolve over a period of years. If you go back, and a lot of you probably have not been around as traders. I mean, I'm going on 40 years doing this. If you go back to the mid-1970s to early 1980s, when interest rates basically went from about 5% up to 20%, the dollar went down in that period. But in that trend down, which went over a period of 7-8 years, there were upward corrections that lasted at times 7, 8, 9 months, okay? But the dollar index went down. When the Fed started cutting rates finally in 1981, 1982, the dollar index embarked on a huge rally. I think it went from something like 90, the Fed's dollar index against major currencies, up to almost 150. And even in that time, and it was a very, very sharp sustained upward rally in the dollar at a time when they were cutting interest rates, bringing them down from 20%. You understand? They were cutting interest rates. Most of you here would think, oh, that's bearish for the dollar. They're cutting rates. Nobody's going to invest. The dollar went on a tear, but even within that very, very powerful uptrend, there were periods of correction which lasted 5-6 months. In the period, and this is a very fascinating period, from 2001, I should say, all the way to 2006, when the Fed under Greenspan took the interest rates from 1% to 6.5%. And a lot of people blamed that monetary policy on triggering the housing crisis. That's a whole separate discussion. But in that period, when interest rates were raised from 1% to 6.5% from 2001 up to 2006, okay, interest rates were raised. Hear what I'm saying? The dollar index went down. Down! I think it went from something like 111, and again, I'm using the Fed's dollar index, which against major currencies, which basically is equal to the DXY dollar index that you look at. The dollar index went down in that period when the Fed raised rates from 1% to 6.5%. And within that period, within that downtrend, which again was a very sharp and steady downtrend, there were corrections within that trend that lasted for months. And so on and so forth. I don't have the charts in front of me, but you can look it up yourself. There were many periods, and you don't have to even get into whether rates were going up or rates were going down. Look at any trend, major trend I'm talking about, which plays over a period of years with currencies. And that's how they are, because they're really dictated by policy. And I've been all through that at the very minimum, a cycle will last 2 years, because that is every 2 years you get a congressional election like the one we're having coming up next week, the midterm election. And why am I focusing on the U.S.? Because the dollar is still the major, it is the reserve currency, and half of all currency pairs are paired up against the dollar. So monetary policy, fiscal policy, trade policy of the United States is very important in exchange rates. So these trends tend to last at a minimum for 2 years. And by the way, 2 years, that's a short, relatively short-term period. Every 4 years we have a presidential election and a congressional election. All right. And then historically, most presidents served 2 terms. Not all of them did. Jimmy Carter did not. George H.W. Bush did not. But most presidents served 2 terms. So now you're talking 8 years, where policy is basically frozen or sustained for a period of 8 years. So if you're talking about an 8-year period or even a 4-year period, and right now if you're looking at the current dollar trend, which is still in a downtrend after 8 interest rate hikes. Now, we started in December 2015. It's going to be going on 3 years. Very soon it'll be a 3-year trend. You have a correction now which has been ongoing, let's say from April of this year, and we're going into November, so that's 7 months. That is totally, and by the way, the real impulse of that counter trend correction, that upward rally in the dollar, the impulse, in other words, really most of the movement took place in April and May. From June, July, August, September until now, it's basically, like I've been saying, 95, 96, 94. Today it hit just marginally 97. We'll see what happens. So me personally, and I'm not saying you have to follow this, method of trading. A lot of you like your little charts. You want to take your profit 5 minutes later or 2 minutes later. I mean, knock yourself out. I don't do that. I'm a macro economist. I look at a macro picture. I look at policy. I understand that policy is going to remain in effect at the very minimum for 2 years. And within that 2-year cycle, you could easily have a multi-month counter trend move. And more likely, we're talking about a 4-year cycle, maybe even an 8-year cycle. And within that cycle, you can easily have a 7, 8, 9 month, even a 1-year counter trend move. Now, why would I want to do this? You're saying that's, I'm wasting time, right? I might have to keep my position small, otherwise I'm going to be blown out because of the move. No. Anyone, folks, let me tell you a little story. When I was a NYMEX trader, and I was also a floor broker, I had clients in the oil business who I would execute orders for on the floor. They were big oil people. And they saw the big picture about oil, and they didn't put a position on for the next 10 minutes or the next 3 days or the next 3 weeks. They put it on with the objective of holding it out for the entire term over which they saw the certain fundamentals in place. That could be a long time. And they sat there with it, and every single time, to an individual, to a firm, they cleaned up on those positions. But they had to ride out periods when there were counter trend reactions to the fundamentals, to the basic conditions that applied or put pressure or dictated the market at that time. Technical things were happening. Could be a lot of different things. Could be position shifting. It could be news events. It could be the zombies. At that time, we didn't call them the zombies. That's a term that I coined. But that's an explanation to the type of trading that I engage in. All right? So when you come on here and you say things like, oh, it's going up. It's not. As far as I'm concerned, it's not going up. 104 or 103.89 was the high in the dollar index going back in 2007. I believe it was. Maybe it was in 2017, 2016. Went all the way down to 88, bounced up to 97. Still happening. Fed is still engaged with rising rates. Fiscal expansion still happening. All this stuff completely on track, on course to, as I expected it, 8 rate hikes and a hawkish position by the central bank, the Federal Reserve. The dollar is lower. That is an irrefutable fact. So you can make up any story you want in your head about what's going on with the dollar. The fact is 8 rate hikes and a very hawkish central bank, and the dollar is down. You cannot argue against that. That is a fact. That is reality. And I choose to stick with the facts. Anyway, everybody, tomorrow's Halloween. Don't forget, most of you probably already celebrated. Maybe not. You don't even need costumes, a lot of you people. You got your zombie. You got your zombie face on right now. So enjoy. Bye-bye.